To make it clear right away, earning a lot of money does not mean you know how to manage it. Most high earners hit a wall because they optimize everything around bringing cash in, but they completely lack a system for what happens next. The fix for this is a three-part financial architecture called the Money Factory. It is a system designed specifically to legally protect your assets, fund your daily life, and turn your leftover cash into an automated passive income machine. To build this, you only need three things. You need a steady source of active income, you need to know exactly how much your lifestyle costs every month, and you need a piece of paper to map out the blueprint. Building this structure is the dividing line. High-income workers spend their lives trading time for dollars, while financially free individuals architect a system that does the work for them. Let's draw it out. Step 1 is securing Zone 1. This is your active income. It's any dollar that requires you to physically show up and trade your time. Usually, this means a salary from a W-2 job or revenue from your own LLC. The most common mistake people make is routing this money directly to themselves. Instead, you need to establish a living trust. A trust is simply a legal vehicle that owns your assets on your behalf. By putting the trust's name on your bank accounts and investments, you remove your own name from public records. When you set this up, give the trust a completely random name. As your wealth grows, lawsuits and claims will inevitably happen. If a creditor goes looking for your assets, they will find nothing because there is nothing in your name to find. This graphic shows how the system begins for a W-2 employee. Your employer already takes out taxes, so your job is to route your remaining income straight into the trust account on the back end. If you own a business through an LLC, you have to be much more careful. If a client sues you and a judge finds that you mix your personal and business bank accounts, they can pierce the corporate veil. That means the court decides you and your LLC are the exact same entity, leaving your personal home and assets completely exposed. To prevent that, and to solve a massive tax bleed, you file an S-Corp election. This tells the IRS to treat your LLC as an S-corporation for tax purposes. This chart compares the tax flow of a standard LLC against an S-Corp. Normally, you pay a 15.3% self-employment tax on every dollar you take out of your LLC. The S-Corp allows you to split that income. You pay that 15.3% only on a reasonable salary, and the rest flows down a separate path as a distribution without the self-employment tax. You then route that distribution directly into your trust. It bypasses your personal accounts entirely. The entire goal of Zone 1 is simple. Capture your active income and move as much of it as legally possible across the boundary from public vulnerability into private, protected accounts. Now we move to Zone 2, which covers your lifestyle expenses. For high earners, the primary threat here is lifestyle creep. When income goes up, expenses usually follow right behind it, draining cash before it can be used to build wealth. To neutralize that threat, you set up a dedicated routing account called the quarterback. This is an intermediary checking account with one absolute rule. It never holds money. It is strictly a transit point for your cash. This interface shows how the routing operates. Your protected income from Zone 1 arrives right here in the quarterback. Immediately upon arrival, the account executes an automated three-way split. A fixed amount goes to pay monthly bills, a fixed amount goes to tax savings, and every remaining dollar is pushed out to Zone 3. Because your lifestyle budget is locked to a single, unyielding automatic transfer, you eliminate the temptation to scale up your spending just because you had a good month. By forcing the quarterback's balance back to zero instantly, human willpower is removed from the equation. Your surplus wealth is successfully extracted before it has the chance to be wasted. That extracted surplus brings us to Zone 3. This is your passive income machine, fueled entirely by the leftover cash routed out of the quarterback. To be clear, passive income means you are no longer trading time for money. You pre-fund it by buying an asset today, and it generates income on its own tomorrow. If you have to manage it, it is not passive. This pie chart details a concrete example of a liquid cash management portfolio to serve as a Zone 3 engine. It is built entirely on exchange-traded funds, meaning you can move in and out of them like stocks. Looking at the specific allocations, the short-term income slice is built on highly stable government debt, utilizing instruments like treasury bills and treasury bonds. The corporate bond slice operates by lending your capital to established megacorporations. Companies like Google, Microsoft, and GE pay a reliable level of interest in exchange for these loans. An engine constructed like this aims to generate a consistent 7 to 8% yield. That creates a new, independent stream of cash that drips right back into your system. A lot of people fall into the trap of waiting for a massive windfall to start investing, but the math of compounding only works if the machine is turned on today. Even if the initial surplus is small, the factory has to be running to grow. Now that the factory is built, you need a way to measure its success. There are 5 milestones of financial freedom that help you diagnose exactly where you are in the system. Level 1 is stability. Your active income covers your lifestyle. That is the baseline floor. Level 2 is runway. You have 1 full year of lifestyle expenses saved in liquid assets, giving you a buffer if everything falls apart. This graph visualizes level 3, which is the big one, the crossing point. This is the exact mathematical moment your passive income from Zone 3 grows large enough to cover all your monthly expenses from Zone 2. That is the moment you achieve actual financial freedom. From there, you reach level 4, abundance, where your total assets equal 5 times your annual expenses. Finally, level 5 is life by design. You enter a post-economic existence where you only work for the love of the game, while the factory runs itself. If you do not identify your current milestone, you cannot strategically aim for the next one, which leaves most people permanently stuck at level 1. This final flowchart shows the completed architecture. Your protected active income flows through the S-corp into the trust, feeds into the quarterback, and perfectly splits into funding your life and building your passive investment engine. Your immediate assignment is simple. Go to your bank today and open a new zero-balance checking account to serve as your quarterback. Next, take this exact blueprint to a CPA or legal advisor. Show them the structure and initiate the paperwork for your living trust and your S-corp election. Knowing the system is useless if you don't actually build it.